All right, so welcome back to another video, guys. If you are new to this YouTube channel, welcome. And for those who've been here, welcome back. So we are going to continue with our videos pertaining to Forex. So we recorded one video that was introduction to Forex. So we are taking it from there. And today we are going to be looking at something that is very, very important as you are going to proceed in the journey of Forex trading. So today we're going to be looking at candlesticks. So candlesticks, these are tools that are going to use for analyzing the market. You're going to use candlesticks throughout your trading journey to analyze the market, and to be able to place a trade, you're going to be using candlesticks, right? So first thing first, we are going to start with the anatomy of candlestick. So the anatomy of candlestick, we are going to start with two major types of candlesticks. Then from there, we are going to take a look at the entry candlesticks. There are specific candlesticks that you're going to be looking for you to be able to place a trade. So we call them entry candlesticks. So we have two types of candlesticks. We have a bearish candlestick and a bullish candlestick. So a bullish candlestick, we have most of the times when you open maybe MetaTrader 5 or TradingView, you're going to find that the bullish candlestick is indicated by the color green. So this color green represents the candlestick, a bullish candlestick. Now, what is a bullish candlestick? A bullish candlestick is a candlestick that opens from low here. It opens from low, then closes from high. Then inside here, I'll put an arrow indicating the direction of the market. So what do we mean by saying it opens from low and then closes from high? By this, we mean that a bullish candlestick pushes the market up, right? So as we go on, you're going to hear something like a bullish trend, a bearish trend. Sorry for that. You're going to hear something like a bullish trend, a bearish trend. So this one is a bullish trend. It pushes the market up and it closes from high here, opening from low here. So as you can see here, we have open here, close here. So when you have a candlestick that has opened from below, closing from above here, meaning that this candlestick is what is a bullish candlestick. So in simpler terms, a bullish candlestick is a candlestick that has got a close above the open. Then the opposite of bullish candlestick is bearish candlestick. So if the bullish candlestick pushes the market up, meaning that the bearish candlestick is supposed to push the market down, right? So the bearish candlestick opens from high, it closes from below here. By this, we mean that this bullish candlestick, bearish candlestick is supposed to push, excuse me for that, is supposed to push the market down, right? So in simpler terms, you can say the bearish candlestick is a candlestick that has got a close below the open. So the open is above here, then we have the close below here. Now, there is something that you can see like a tail. Here we have something like this, something like this here, something like this. So these are called a shadow or a wick. So the market is always going to form a candlestick that has got a shadow or a wick, right? So this is all about the anatomy of a candlestick. So this body here, this part here, the shaded part, the bigger part is called a body. Then this part here that looks like a skeleton or a tail is called a shadow or a wick, right? So this one is called a wick. This one is a what? a body. Now let's take a look at some of the entry candlesticks. So entry candlesticks, these are candlesticks that you're going to use for you to be able to enter a trade. So at a certain zone, at a certain level, if you see an engulfing candlestick, so call these ones engulfing pattern. So if you see an engulfing pattern like this one, like this one, you're going to get used to these patterns as we continue with our videos. So make sure that you stick around so that you can understand what we are talking about these candlesticks. So we have a bullish candlestick, we have a bullish engulfing pattern. So bullish engulfing pattern, let me say the market was going down, then at a certain level, you see a bullish engulfing pattern, meaning that the market is most likely to change direction and start going up. So what are you going to follow? You're going to follow the candle that has engulfed, the one that has surrounded the other one. So in this case, we have this red one being surrounded by the green one, meaning that it's giving us a hint that the market at that particular level is supposed to change direction and start being bullish. Same applies to here. This is the bearish engulfing. We have a bearish engulfing the bullish. So meaning that the market was going up. Then when we have a bearish engulfing pattern, we expect the market to start going down. And these are applied only at a certain level, right? So now let's take a look at another one. We have doji here. So we have gravestone doji, something like this. It has got a long tail and like a small body here. So this also shows you that the market is about to change direction, right? So you'll find this one at the end of an uptrend. So when the market is going up, then you see the formation of this candlestick, meaning that the market is showing rejection. You are going to get used to these things that I'm talking about right now as we continue with our videos. I'm just giving you an overview so that you can be able to follow as I'm going to be talking about, the reverse candles, as we're going to be looking at, the supply and demand, the trend and whatnot. So the next one, we have a hammer candlestick. We have something like this, a hammer candlestick. So whenever I see a formation of this type of a candlestick, it means that the market at that particular moment is most likely to change change the direction. Okay, so these are three types of candlestick that I usually use for me to be able to catch a move, to be able to place a trade and whatnot. Now, let's take a look at the directions in which the market moves. Let's take a look at the direction in which the market moves. So, so the market is going to be moving in this type of, it's going to have some kind of something like this. So the market always moves in a zigzag way. So the market is going to move like this when it's going up. Right? Okay. So this is an uptrend. We call this market an uptrend. So the market that is going up is called an uptrend. So let me say have an uptrend there. Then we have downtrend here. The market is going down, is going to be forming something like this. So this market is in a downtrend, right? So the market is trending downwards. So then we have the market that which looks like this. So obviously you can't tell which direction this market is going to. So this one is called a ranging market. So this one is called a ranging market. Something which looks like this is called a ranging market. So the market will move in these three directions. The market is either going to be moving upward or moving downward, or it's going to be making something like a ranging, something like this, whereby we don't have a definite direction of the market. We don't have a direction of the market, whether the market is going up or it's going down. So the market, always you have to remember that the market is either going to move up or down, or it's going to make something like a consolidation like this, right? So a good example is what I have here. I have something for you. So we have this one here. So an uptrend looks like this, an uptrend. An uptrend is also called a bullish market. So we have the market forming the higher high and lower high, higher high, higher high, higher high, higher high, and lower high. So the market that is going up is going to be forming this. By lower high, we mean that the next high the market is supposed to make is supposed to be higher than the previous one. And the next low the market is supposed to make is supposed to be higher than the previous one. So if the market is supposed to make the next low from here, then the low is supposed to be higher than this low here. Then we are going to say the market is in an uptrend. Then we have a downtrend, what we call a downtrend here. We have a downtrend. So a downtrend is an opposite of an opposite of uptrend. So we have the lower low being formed. Then we have the higher low. We have, lower high. We have lower high. So by saying lower high, we say, let's say we have this one as the first high, then this one as the second high. So this second high is supposed to be lower than the previous one. Then the third high is supposed to be lower than the second high. Then the fourth high is supposed to be lower than the third high. Then we're going to say this market is moving in a downtrend or in a bearish trend. Then here is supposed to be making the same, the low here. So the low that the market makes here is supposed to be the highest. Then the next one is supposed to be lower than the previous one. Then the next one is supposed to be lower than the previous one. Then the next one is supposed to be lower than the previous one. Then we are easily going to say that this market is in a downtrend, right? So we have the last one now, which is the ranging market. So the ranging market looks like this. It doesn't give us a definite direction, just looks like is in a certain zone. You can draw something that looks like a rectangle, and you're going to see that this market doesn't give us a defined direction of which it's taken. So as you're going to be looking at this market, there are a few things that you have to know. So when the market is moving up like this, when the market is going up like this, as a trader, you are supposed to be looking for buying opportunities. So when the market is going up like this, the only thing that you're going to be looking for are buying opportunities. You don't sell when the market is going up. So when you buy in Forex trading, you expect the market to move up. So when you are buying, meaning that you are anticipating that the market is going up. So in short, when the market is in an uptrend, you're going to be looking for buying opportunities. You don't look for sales opportunities when the market is in an uptrend. Then when the market is in a downtrend, you are supposed to be looking for selling opportunities. Then when the market is in a ranging, you are not supposed to be doing anything. You stay away from the market. So you're only going to be trading an uptrend or downtrend. Which uptrend you're going to be looking for buys, then downtrend you're going to be looking for sales, right? So now let's take a look at a practical example of what a downtrend, uptrend, and ranging market is. So let's go and look at something like let's remove drawings. So a good example of what a downtrend is, a good example of what a downtrend is this one, starting from here all the way up to here. So this one was a downtrend. This one was a downtrend because the market was making these levels. So these levels the market was making. This one was the first high. Then the next high the market made was lower than this previous one. This one was the previous one. But if we look at the next high here, is lower than the previous one. Then we have this high here, which is lower than the previous one. Then we have this high here, lower than the previous one. Then we had this high here, lower than the previous one. Then we know that this market is in a downtrend. We also have this low, and this low, and this low here. Then if you look at this low, it's lower than this one here. Then this low here is lower than the previous one. This low here is lower than the previous one. Then we can easily conclude that the market was in a downtrend. Now let's take a look at what an uptrend looks like. What an uptrend looks like. So if you take a look at what is happening right now on this particular so the good example of an uptrend we could give was here, starting from here. Look at this high was the low was the first one. Then this low here was higher than the previous one. This low here was higher than the previous one. This low here was higher than the previous one. Then this low here was higher than the previous one. Then we could easily say that this market was in an uptrend. Okay, so this market from here all the way up to here, all the way up to, so from here, from down here, all the way up to here, this market was in an uptrend. So this was an uptrend. Then a good example of what a ranging market is, I think we can just find it from here. Good example of what a ranging market is was for this one. So if you take a look at this one here, this was a ranging market. This was a ranging market. Let me put it in red. This was a ranging market. This was a ranging market. Put it in red. Yeah, this was a ranging market. Let's take a look at how the market was moving. The market was moving like this. From here, goes this way, comes here, comes lower there, goes up, comes here, goes up here, down, up, down, up here, comes here, then comes to break, right? Comes down here. So if we take a look at in this zone here, there was no defined direction of the market. So in this zone, we could say the market was ranging here. The market was not going anywhere. It was just ranging. So when the market is making something like this, you stay away from the market. More especially beginners, you are advised to be staying away from the market when it's forming something like this. Then when the market is going up, as the example that I've already given, like from here, and the market is going up like this, the way the market was going up from here all the way up here, what you'll be doing is you're going to be looking for buys from here. You're going to be looking for buys. You're going to be looking for buying opportunities in a moment where the market was moving like this, down like this. Market was moving down like this. You're going to be looking for buying opportunities. So you can see, you guys, that the market always is either the market is moving up like this, or it's moving down. It's moving up and down, or is making a consolidation. So these are things that I want you guys to go and, you know, something like this, right? So an uptrend, let's say an uptrend, this is an uptrend. Then we have a downtrend. These are things that I want you guys to pay much attention to, because you are going to be using these things every time when you want to trade. You're going to be looking for these things. And as a trader, when you look at the market, within a few minutes, you're supposed to be you are supposed to be able to identify the trend of the market. So we have the market that looks like this. This is the ranging market, right? So as a trader, you are supposed to know these three types of trends, which are the downtrend, this one a downtrend, then we have an uptrend, then we have a ranging market here. So thank you so much, guys, for joining us. I don't want to keep this video very long. See you in the next video, where we're going to be talking about supply and demand. Then we are also going to talk about the fair value gap and many other things. There are many other things. So for you to be able to understand the next topic very well, you have to understand the downtrend, uptrend, and the ranging market. And also, if you'll be able to go and research on your own, go and research, so that in the next video, you won't struggle to understand. Thank you so much for watching. Don't forget to like, share, and subscribe. This is World Factory Forex. Have a good evening, good morning, a good afternoon, depending on what time you're watching this video.